The massive clothing retailer Gap Inc., parent company of several brands, including its original Gap stores, is breaking up.
Some big news out of the company with plans to separate into two separate companies, spinning off a yet-to-be-named company, NewCo, which will consist of the Gap brand, Athleta, Banana Republic, Intermix, and Hill City. Then the remaining company will be Old Navy.
Gap's net sales slowed at the turn of the 21st century, well before the financial crash of 2007 devastated the retail industry. Over a decade later, Gap Inc. continues to struggle. This is largely due to the Banana Republic brand and the original Gap stores, which haven't recaptured the explosive success they cultivated in the 1990s. For the last few years, Old Navy and the athleisure brand Athleta have carried the company. Both have shown consistent year-over-year sales growth post-recession. Gap stock surged by over 20% the day the news broke, as investors and analysts applauded the move.
Frankly, it's about time. Old Navy is a nice business, 30% same-store sales growth, despite having an anemic fourth quarter. Now it'll finally be able to free to grow on its own. If it's laser-like focus, I think they can beat the 3%.
But others are skeptical, calling it simply a move to boost the value of Old Navy.
My initial instinct was that this was a move for valuation, meaning that Old Navy's valuation was probably a little depressed being inside of Gap Inc.
They've had to do something to get the stock higher. This feels like that's something to get the stock higher. But this is about the stock. This is not about the company.
Whatever the future holds for Gap, this is a stunning move for a company that grew from a single store in San Francisco to become the defining apparel retailer of the 1980s and 90s. The first Gap store opened as The Gap in San Francisco in 1969. The store's name was a reference to the generation gap between the young liberal baby boomers and their conservative post-war parents. Hoping to entice the huge baby boomer generation, the Gap's founders, Donald and Doris Fisher, decided to sell nothing but records, tapes, and wildly popular Levi's jeans. Jeans, especially Levi's, boomed in the 1960s and 70s due to what fashion historians call the casualization of the American wardrobe after World War II.
People didn't look sloppy, but they certainly adopted more casual bottom elements into their wardrobe. It was this very clean, simple approach to getting dressed.
The Gap was an immediate success. By 1972, it had 25 stores, including one across the country in New Jersey. In 1973, it began offering other brands besides Levi's, as well as its own Gap label. By 1975, it had 186 stores in 21 states and sales of $100 million. It went public the next year. Donald Fisher appointed Mickey Drexler as Chief Operating Officer and President in 1983. Under his leadership, the Gap saw explosive growth throughout the next 2 decades.
Under the leadership of Mickey Drexler during the 80s and 90s, the Gap used to be the premier growth retailer in America. At the time, it was smart, even hip, as my parents would have said.
The Gap expanded its own brands, founding Gap Kids, Baby Gap, and Gap outlet stores. It even dropped Levi's, the only product it sold in the original Gap stores, in 1991. It also expanded beyond the Gap label by acquiring Banana Republic in 1983 and launching its discount brand Old Navy in 1994. With these, the Gap targeted 3 tiers of consumers: Banana Republic for the upscale, Old Navy for discount shoppers, and the Gap for everyone in between. Old Navy in particular took off, reaching $1 billion in sales by 1997.
I was in store number 1 for Old Navy, and I remember walking out, calling back and saying to my boss, I've just been in the coolest, cheapest store on the face of the earth, and Old Navy was back in those days. They were the fastest retailer to go from $0 of sales to $1 billion of sales.
The company simultaneously expanded worldwide. It opened the first international Gap store in England in 1987 and expanded to France and Japan in the 90s. Finally, the Gap embodied the casual cool basics trends of the 80s and 90s. The casualization of the American wardrobe continued into these decades as offices began allowing increasingly casual attire.
Where the Gap really kind of took off was casualization in the office. The last leg of casualization came really when people started wearing khakis to work on Friday. Casual Friday is the easiest way to think about that.
The Gap made improbable clothing like khakis and turtlenecks cool. In 1993, it released an ad campaign featuring dozens of celebrities in khakis. A few years later, actress Sharon Stone wore a Gap turtleneck with an Armani jacket to the 1996 Oscars. Gap's annual sales grew from $307 million in 1980 to over $1 billion just 7 years later. By 2001, sales had ballooned to $13.8 billion.
When you adjust for stock splits, Gap traded for 20 cents when Drexler took over in 1983 and peaked at $52 in 2000. Wow, what a spectacular run, with the last big leap coming from the rapid expansion of Old Navy right before the turn of the century.
At that time, though, the U.S. economy slowed down. The Gap sales grew at 28% and 17% in 1999 and 2000, but slowed to 1% in 2001. It hasn't hit double digits since. But a sluggish national economy was only part of the problem. First, by the early 2000s, Gap's apparel had lost its cool. Casual basics gave way to Britney Spears-esque low-ride pants and crop tops, which weren't Gap's forte. Banana Republic and Old Navy carried the company, as the Gap brand struggled to deliver what consumers wanted. Next, the boardroom was in turmoil. In 2002, then CEO Mickey Drexler retired after 2 years of sluggish growth. Drexler's design-driven leadership had faltered when trends changed in the early 2000s. The company replaced Drexler with Paul Pressler, a former Walt Disney executive. Pressler used the cost-cutting ethos he developed at Disney to improve Gap's efficiency. It seemed to work. Sales growth rebounded to 9.7% in 2003. But a New York Magazine profile from the time noted that this uptick was likely due to products that Drexler chose before his departure. And it didn't last. Sales growth fell back to under 3% the next year, then slipped into the negatives. Glenn Murphy, former CEO of the Canadian drugstore chain Shoppers Drug Mart, took over in 2007. CNBC reported at the time that Murphy planned to give the design team creative freedom, reflecting Gap's continuing struggle to be cool again. As sales in the U.S. fell, Gap again pursued growth abroad at a much faster pace than in the 80s and 90s. From 2006 to 2008, the company opened dozens of Gap and Banana Republic stores across the Middle East and Southeast Asia. But then, of course, the Great Recession devastated Gap and just about every other retailer. Whether the Gap was cool or not hardly mattered. Consumers slowed or halted apparel shopping to save money. Under Murphy's leadership, the Gap tried several methods to revive sales. It embraced strategies to integrate digital and physical shopping experiences, like allowing customers to shop online and pick up items in store. Gap also acquired 2 new companies, Intermix, a women's fashion brand, and Athleta, a fitness and athleisure brand. Athleta, in particular, capitalizing on the spike in athleisure's popularity, has succeeded where other Gap brands have struggled. From 2008, when Gap acquired the brand for $150 million in cash, to 2014, the athleisure brand grew from an online-only presence to about 80 stores. Gap doesn't break out Athleta's sales numbers specifically, but the other portion of its revenue, of which Athleta is a part, consistently posts the best sales growth in the company. During Murphy's leadership, Gap's overall sales trended upward again, reaching a peak of 8% growth in 2012. But Murphy stepped down in 2014, and sales drifted downward once again. The company hasn't yet released its 2019 earnings, but sales at Gap stores fell every year from 2013 to 2017, and Banana Republic fared just as poorly. Millennials have flocked to digitally native brands like Everlane, fast fashion giants like H&M, or even secondhand companies like ThredUp. Fast fashion retailers in particular have captured a rapid-fire wardrobe replacement rate driven by social media.
And I've seen it, dozens of times in the mall where people are shopping and they already own a ton of clothing in their wardrobe, but things have already been all over social media, and so they don't want to wear it again.
Old Navy and Athleta have carried the company for the last few years. To expand on Athleta's success, Gap launched a men's athleisure line, Hill City, in 2018. Meanwhile, Old Navy leans on its family-friendly prices and shopping experience.
They know how to really integrate the right fashion of the moment for their customer at the right price, and I think they're doing a great job.
Old Navy is of particular importance to the company, making up over 40% of its sales since 2014. By 2020, though, the discount brand will become its own company. This will leave the Gap with 2 struggling behemoths, the Gap and Banana Republic brands, and a mixture of much smaller brands, Intermix, Athleta, Hill City, and the newly acquired children's clothing line, Janie and Jack. Analysts point to Athleta as the brand with the most potential to drive future growth.
I think that a lot of people would have assumed Athleta would have been grouped with Old Navy. It will be the crown jewel. It will need to carry. It will represent the growth, but it's also going to be benefiting by being part of a larger company.
Gap's current CEO, Art Peck, said the split, which should be complete by 2020, will help each company craft a sharpened strategic focus and tailored operating structure. But why now, when the retailer has struggled for consistent success for so long?
I think the reality is that appears it's an acknowledgement that the Gap really isn't going to turn as quickly or as much as they had wanted it to.
If NewCo does revive the ailing company, it's possible that the iconic Gap brand itself will play a smaller role than it did in the company's history.
It's certainly going to be, relatively speaking, a much less important part of this business once you separate them off. So if you can shrink Gap, grow Athleta fast, grow Hill City fast, those pieces are more important to the shareholder.